Hey everybody, thanks so much for joining us again. We're going to be talking with Armando at Legacy Texas Bank about some other product options, including for those of you in 1031s that are looking to do cash out purchase and refinance. So thanks again for being with us, Armando.
Thank you for having me. Looking forward to the talk.
Absolutely. So I'm going to just leave this up for a second while we chat a little bit. But for those of you that want more background on Legacy Texas and on Armando, I recommend you check out the first video where we go through portfolio lending because we really want to get to the nitty and gritty of what we're talking about here. So a lot of clients have these large 1031s going, and some of them are concerned about timelines for identification and closing. And of course, we do it every day and we make it happen, but some people would rather pay cash and then cash out refinance without having to worry about the 200% rule and all the other things that go hand in hand with trying to leverage up front on a 1031, especially some of these large ones we're seeing from those liquidating out of California and New York. So tell me a little bit about how your process works if someone buys a property in cash and wants to refinance back out after.
It's as simple as a purchase transaction. It's the same thing to us. So a cash out loan or a purchase loan, we're going to have very similar terms and very similar structures and a very similar process. So whether you're an individual or an LLC or a corporation, we can help with a purchase or a cash out solution.
Okay, fantastic. And so when we talk about the terms for portfolio lending, we're really looking at the same type of terms here for this product. You're just getting it on the back end instead of on the front end.
Exactly. And so what the typical terms and structure on one of those loans is going to look like is going to be that we will finance up to 80% typically of the value or cost, whichever is less, of the property. So most of the time what that means is you're going to have at least 20% equity into the property, up to 30%. And that's going to give you the ability to have some flexibility in how much equity you're having to put into the project.
Perfect.
From there, we're going to look at the loan term. So we're going to have a 10-year term on the loan, and so the loan will have a balloon feature. And what that means to you is that the loan will mature before you actually finish paying it off. And the reason for that is that this is a portfolio loan, whether it's a purchase or cash out. We're going to be holding it on our books. That's what portfolio loan means. And so we're going to service it ourselves, and you're going to be dealing with us directly. And because of that, we need to make sure that the loan has performed how it should, and that the market is still there, and that the property value is still there after 10 years. And so that's one thing to consider here, is that there is that feature. However, with the way that Leah looks at properties and turning them over, that's not really an issue. And so the final element of the terms and structures that's keenly important is going to be the repayment, right? The amortization. And so you're going to have the ability to have a long-term repayment of 20 years, sometimes up to 25 years, a 10-year note. And so you're still getting a repayment based on a 20 to 25-year schedule. So you're able to maximize your cash flow, again, have flexibility there, and we're able to revisit the loan. The last element of that is going to be, everyone asks me, what's the rate going to be? And so typically on these structures, we're going to be setting the initial 5 years at a stated fixed rate. So you're going to know very specifically that it is a certain percentage for the first 5 years. Then thereafter, for the second 5 years, it's also going to be fixed at an index plus spread that's already built into the loan. So that may not matter, but at least it is a 10-year term. It may not matter if you're selling the property within the first 5 years. However, it is a 10-year term. It is a fixed rate option for the first 5 and a fixed rate option for the second 5. So it is built into the loan if you need that.
Perfect. Well, those terms are really easy to work with. The one thing that I recommend you guys keep in mind is that when you refinance back out on the back end, you are in some cases going to have some expense for title insurance, for escrow fees, et cetera, if it has to close at a title company. And so that'll be one of the things you can discuss with Armando about how that works. Now, of course, on the front end purchase where you work with us, we typically get the seller to cover those costs, or in their majority, specifically title insurance, survey, et cetera. But when you're refinancing cash out on the back end, there's no seller involved that we can ask to pay those fees for you. So as you talk with Armando about how you want to structure these deals, that's one of the questions you can ask about whether or not it needs to go to a title company, whether they can close it locally, etc. Now, one of
And
the other things, oh, go ahead.
yeah, I was just going to say, Leah, as we're talking about costs, I think it's important to touch on the costs associated with the loan, and I think we can do that pretty simply. Other than interest expense, the only charge that the bank is going to have is going to be an origination fee related to a real estate loan. And so typically that fee is going to be somewhere between 0.75% and 1.25%. There are times where we can do a little bit better on that fee in terms of lowering it just a little bit if perhaps we're charging some other interest rate or you're putting a considerable amount of down payment onto the property. And so outside of that expense and interest, you're not paying the bank anything else. All the other charges related to the actual loan are going to be third-party expenses without markup. So we're talking about an appraisal. We're talking about a flood certificate, the title policy, the title escrow costs. So all of these things that are just standard and typical of any real estate loan. So if you've done real estate loans in the past, whether it be a conventional mortgage or any other type of real estate loan, these are the types of costs associated with those loans.
That's perfect. You know, one of the things that I always look at when we're looking at these direct bank transactions is when you hire these companies that go and then they come to you as a bank, you're having to pay them for being that middleman. And so by going directly to you and working directly with you in your position at the bank, you're avoiding all those extra origination fees and costs and markup that you would otherwise have.
Absolutely.
So now let's talk about a little bit of a unique option and tell me about the benefits of using a line of credit, because this is something that you guys do frequently and lots of investors are looking at this as a more viable option, especially as the market's moving so quickly. So tell me a little bit about this.
So the line of credit solution is really our best way of facilitating a quick close transaction. So whether that be because you're looking to flip a property or because you think you want to get some rehab completed before you get an appraisal done on a property, or just because you maybe find a very short turnaround sale or a sweetheart deal, then we have the option or the ability to put a line of credit in place for those quick funding needs. And so the way that this really works is we are going to take some thing as collateral. Most of the time it's some other real estate property, some other single family, multifamily property that you own free and clear, that you have no debt on. And then what that allows us to do is we will take the collateral being that property, and then the loan amount is available to you under a line of credit so that you can use it to either buy another property or invest in some other real estate transaction or something related to that. And so the beauty of it is that when you have a line of credit and you're not using it, there is no ongoing interest expense. If you don't have a balance and you're not actually utilizing the line, then you're not going to pay anything on a monthly basis. And then when you actually do use the line, you're only going to pay interest for as long as you actually use the money. So if you have funds outstanding for 10 days, you're only paying 10 days of interest. And so that is a very much a cash flow tool to manage your cash flow, especially if you're in the market of possibly doing some buy and holds and some flips, or perhaps you want to acquire some properties and bundle them together in a loan. Well, this is an opportunity to do that. And so the way that the structure and terms look on something like this is that we're going to finance up to 80% of the value of the properties or the value of the real estate that we take. Depending on the nature of the real estate, we may have different advance rates. Depending on the nature of the collateral, we may have different advance rates. And then depending on the nature of the real estate, we may have different advance rates. But big picture, we're going to finance a certain amount based on the value of the collateral. And we're going to put that credit line in place for up to 48 months. And so you're going to have a committed line of credit that you can use for that amount of time. And so this is, again, something that's great because you're not having to do it. You're not having to renew the line on an annual basis. And that's, again, because of the real estate collateral primarily.
Exactly.
The other important part of that is that the interest rate is going to be fixed similar like we would fix a purchase or cash out loan. And then the repayment is one of the maximum features of a line of credit is that you get to decide when you pay the principal back, as long as it's understood that there's going to be principal performance on a regular basis. And so how this looks is we'll have customers that will buy a property under the line of credit, rehab it with the funds from the line of credit, and then when they're ready to decide, let's say they decide to buy and hold the property. So they fixed it up, they like it, they're going to rent it out. Well, then we will get an appraisal on that property and create a new loan specifically for the purchase or for the long-term financing or short-term, long-term financing of the property, which then frees up the line of credit because we've created a different loan that pays down the line of credit, and then you have access to the line of credit again to do it again. So that works very well in those scenarios where you're trying to find properties quickly and close quickly.
So a lot of us are sitting on a lot of cash, and a lot of us are not really sure where to put it other than real estate. How can we utilize cash for lines of credit to basically back the line of credit? You know, I'm a big believer in this so that you can take on the debt while also still having the cash to cover it. And what are the types of terms for something like that?
Okay, so that's the easiest loan we make, right? A cash secured line of credit. And so then people's question to me usually is, why would I use my own cash to secure a line of credit? Why wouldn't I just use my own money? And my answer to them is that if you are looking to leverage, if you're looking to use financing as a method to increase your buying capacity, then the cheapest form of borrowing is going to be a cash secured loan. Whereas we might charge, let's just say approximately 6% on a line of credit, the rate on a cash secured loan is probably going to be 2 to 2.5%. We're going to be charging you essentially 2% over whatever we're paying you on the deposit. And so then your cost of funds is 2%. And so that means that you're getting to borrow money at an extremely low rate. And there are situations where we might even provide a line of credit in excess of the amount of collateral we're holding if you're qualified to do that from a credit perspective. And so then you get to maximize that amount of collateral that you're putting up. And so I think that's really the most important thing to consider, is that with a cash secured line of credit, you're lowering your interest expense significantly, and you still may be able to maximize the amount of equity that you can deploy.
Exactly. And a lot of us are sitting on the cash anyway. And the other thing that I look at is, so you use $200,000 as an example. You take out a $200,000 loan, you're now showing that you're down $200,000. Whereas you're sitting on cash, you cash back $200,000 in a line of credit, and then you charge it up. It's basically a wash because you've got the cash offsetting the debt. And so in my mind, for those of us that are sitting on cash, and I get this question a lot, what do I do with it? I don't trust the stock market. I don't particularly want to go in oil and gas. Real estate's the only thing I'm looking at, but I don't want to put all my eggs in one basket. This is a way to really invest in your own operation. And so I'm a big believer in this, and specifically those of us that are doing a lot of quick closes and rehabs and all these different things. It's a good avenue to look at other than taking an unsecured line when you still got cash sitting there anyway.
That's a great point.
All right. Well, I really appreciate it as always. And of course, our information will be in this presentation for you to be contacted. And then we'll be doing a Q&A next week, and we'll send out the date and time for that, where you can ask Armando questions live and interact with other members as well.
Thank you for having me, Leah.
Thanks so much, Armando.